So, hey, hi,
Yeah.
I'm audible. Okay. In this session, we are going to discuss about different structures of a fund. Why, the structures are important. Why even fund creates, such a structures within their, let's say, AMC, asset management company, and what are the pros and cons of this even, structures, as well as means from accounting perspective, how we do the accounting and all under each and every structure that we'll discuss. All right. So first structure that we're going to discuss about is standalone structure. Standalone, it means stand and alone. So it's a single fund structure in short. When we say standalone, it means it's a single fund structure. Single fund. If you have, let's say, only one fund without any mixture of multiple securities, multiple, it means it's a combination of, equity, bonds, debentures, options, or different, securities and all. If you have, let's say, less mixture, and even the investors and even AUM, asset under management, is very less, let's say 100 crore. So you can easily manage in one fund, right? If I talk about 10,000 crore, you won't be able to manage under one fund. So you will have to create multiple funds or maybe different structures. Why? The reason is, see, when we establish or create any structure, the base would be risk, base would be investment type, then tax treatment, all right, risk type. Already we have covered risk type, risk, investment type, tax. Then again, if it is international or domestic, that you can say onshore, offshore. Onshore, offshore, tax, investment type, investment, ooh, yeah, even investment cycle or fund type, I would say, whether it is open ended or close ended. Onshore, offshore. Then tax, yes, no. You can select investment type, let's say equity. So it means you would say only equities. Risk, of course, when you say equity, it means risk could be high. When you establish or create any structure, your base should be this. First, define the risk, then investment instruments, tax status, whether it is taxable or non-taxable, then onshore, offshore funds basically, and fund type. First decide that and then go ahead with your structure. If you don't have a details for it, let's say risk or investment type, tax, onshore, offshore, and the other information, then you won't be able to do it. You won't be able to create any structure. Then you can manage easily. See, why we created without structure also, you can easily manage your funds. How? I'll tell you. Create your fund means own entity, open bank account, accept fund from investor, and record that in your in the books of account. That's all. You don't need to follow any further treatment even. But why we go ahead with structures? Because that structures help us to manage the expenses, income, investments, risk, everything in an appropriate way, so that you can utilize the funds or even channelize the fund in an appropriate way. That's what the structure is important. If you have a high fund size or multiple income, multiple instruments, then if you combine all your instruments in one fund, again it creates lots of hodgepodge, so that it will take again time to generate or produce anyway on time to time. Even it will take time to file your regulatory, the filings and all on time to time, because for each and every instruments we file regulatories that submit details to the regulators on time to time. So it will take time. But if you have a standard structure in place, in one click that you can generate reports for that particular fund and submit it even regulators within a let's say short time span. And of course, if some, let's say, if any structure is offering that in a facility, then funds will go with that structures only, and that's what your standalone structure come into picture. So it means if you have, my point is, if you have a tax structure, it means, let's say, you have a taxable investor as well as non-taxable investors. Then you cannot, invite all investor taxable and non-taxable in one pool. If you do this, then again it will take time, or it will, you would see only difficulties to calculate their tax liabilities and all. Then what's the solution here? The solution here is, why don't you create a separate series for taxable investors and separate series for non-taxable investors? Because if you categorize investors on the basis of tax, then you can easily compute NAV for every, means that particular series, or let's say class, and you can update it in the, you can update the tax liability as well. You can update it in one go. All right. So are you getting my points, Sunny, Suraj? So when we establish any structure, so before that we do some framework, means fund manager, they do some framework and find out the investor categories, then onshore offshore structure, whether it is international or domestic, closed and open and investment instruments, risk, and then accordingly they go ahead with the structures. And of course cap, it means limit, fund size, you can say. Fund size, there is no any standard amount or standard, let's say, cap which define like 1,000 to 10,000 crore you can have this or that structure. No, that depends on the fund. As I said, why fund structures are important? Because fund structures help us to standardize your accounting process, and even it will help you to compute NAV quickly. Otherwise, if you don't have a structure, then it will take lots of times to get the all information in one place to compute NAV and all. All right. Now, so in this particular structure, if you see, this one is your standalone. Standalone, it means single fund structure. Single fund. So you have only one fund, but under one fund, you might see multiple series. In this case, if you see, we have a two series, series A, series B. And under series, you might see class 1, class 2, class 3, class 4, or even multiple classes also. Now your question would be, why we create multiple classes? If you just check your SIP structure, mutual fund business, what happened? Every month we received some amount of investment from investor as a subscription. Am I right?
Yeah, yes. In terms of SIP, or they release sometimes if it's they create a new window for investors to invest.
Correct. But now you tell me, you have received amount in the month of January, even in the month of Feb, April, May. So every month you are getting amount from investor. How will you manage that? Every month.
So they do not. I mean, so they do not put those amount into the same like initial when they started off the fund.
Initially, you will receive amount, right? Let's say in the month of January, you have started scheme in the month of January. So January month also you will receive amount, but every month also you will receive amount through SIP.
Right. Yeah.
So if you add, let's say you have received fund in the month of, let's say, December, and you are adding that fund also in your January, scheme, that doesn't make any sense at all. Why? Because of their hurdle, because of their fees, because of their other expenses, because of their, they're going to complete their accounting now. What if let's assume it throughout the year your NAV was 10, means from January, people who you have invested in the month of January at price of 10, right? Due to some fluctuations or due to some XYZ thing, there was huge volatility in the market, And in the month of November also NAV was 10. Let's say Suraj decided to join that same fund in the month of November, and he subscribe or purchase NAV with 10 rupees value. But by December, that price reached to the 20 rupees due to, let's say, positive market sentiments. Now you tell me, you are there in the fund since last 1 year, your profit percentage is also same. Suraj just entered 1 month back and his profit percentage is also same. Is it justifiable?
No, not at all.
Are you getting my point, right?
You just got lucky.
So that's what series will help you. Series will ensure that, okay, do one thing. I'll create a separate series for Suraj. Let's say for Suraj, the series is, let's say, January series. And I'll create for you, let's say, series is December. So what it means, I'll record your subscription separately under your class. So I'll not mix your class with Suraj's class. I'll compute his expenses, his liabilities, and everything under his class only, and I'll record same subscription, investments, expenses, redemption, NAV, trial balance, everything under his class. Are you getting my point? So in that way, it will be ensured that everything has been fairly allocated. Everything has been fairly allocated. So without any
Okay,
challenges.
sure, I get the point, but some of the funds are like been running for more than 5 years, 10 years. So
Yeah.
I mean, so do you think they would have created so many series of those?
Yeah, they created.
And do they close also these
Yeah,
series which
yeah, they
was
close it.
created like?
At the end of the year, yeah, I'll come on that point as well. So there would be one main series. Right? There would be one main series. Let's say January is a lead series. That's what they call, which is lead series. So every month or every year or every whatever cycle that they have, so they accept the subscriptions and they create child series. They create child series. They first decide high watermark and everything and even duration. Let's say 6 month duration, maybe 1 year duration, and at the end of the year, they just merge all their child series into lead series, and they reallocate units even to the investors. But that will not, they'll ensure it, that will not impact on individuals' wealth. Let's say in C series, your wealth here, if you see, in every series, NAV after incentive fees is, see, incentive fees, if you see, different. For each series, incentive fees percentage is different. Right? We have computed it, we have calculated it, we have different series, right? Month of January, Feb, March, April, June, September. So in every month, almost we have new series. But we have also calculated incentive fees, right? Number of shares we have same. But at the end of the year, we have consolidated all series into lead series. And when you consolidate it, so do the total of, or you can aggregate total assets value of all your series, and even you can compute NAV as well. Right? You have 1, 2, 3, 4 total assets, 50 units, 50. So if you want to here increase and decrease the number of outstanding shares, you can do that as well. If you don't want, then that's fine. Just compute it 124. So this NAV you can reallocate to the all investors. So that's become your new allocation. First consolidate the NAV and even reallocate it. So here possibility would be sometime you can, let's say your lead NAV was 1249. So you can again bring that your NAV to that level as well. So how you can do it? So calculation would be like your total NAV divided by per unit price. So you will have only 5 units then in that case. This units. Total. No, the total calculation would be different if I'm not wrong. So they have 10 units, 10 units, 10 units, and A for 4 units, number of shares. Let me just quickly calculate this amount into number of units. So now if I compute this one, 50, now it will die. See, means at the end of the year, or maybe let's say whenever that your cycles ends, so that you can collect or aggregate or consolidate all your different series in lead main series, right? And then you can reallocate. So if you see, we have reallocated units first, second, third. It means you have first, second, third investors. So investor wise, there is change in shares, but there is no change in basically their investment percentage. So you would see equal. If I see this one, third series, where is third series? Third series. It is exactly matching 1249, 1249. So we have allocated now. So it means at the end of the year, we'll bring all series under main series, lead series. Why? Even if you create a multiple series, then that doesn't make any sense. The reason is once you create a new series, so it means you will have to prepare financial statements separately for each series. So now you tell me again, if you create a multiple series, then you will have to hire people to manage who can compute NAV and all. So that process again, it's a costly process. Why will you increase your cost? Will you increase your cost, Ani?
No, that's correct.
Then what would be the
You need
best
to reduce
way?
the cost.
What would be the best way to manage multiple series? Best way to manage.
So, so consolidating into one, and then so how does it make a difference if we had start like we have initially now consolidated into one
Hmm.
for the entire one year.
Hmm.
If we had started off with only one lead series,
Hmm.
so
I'll tell you a secret here how it works. So they basically set the high watermark. Okay.
okay.
They basically set the high watermark. So if you want to get into, let's say, your lead reel, then first you need to achieve your high watermark. And if you don't
Mm,
achieve your high watermark, then it will not allow you to consolidate. So it means eventually once
okay.
you invest, so it will take time, at least 1 or 2 quarter to meet that whatever, let's say, expected return benchmark was set with the investor. Let's say 10%, 5%, 20%. It should meet.
Mm, mm,
So when you create any new series, you always set up qualifying parameters to get the member of lead series, and that's
okay.
how it will get justice to everyone. Even the member
Mhm,
joined any fund in the month of December, then you cannot merge that person directly in your lead series. So always you will create a separate series and you will maintain it separately even. But once that series, let's say,
mm,
achieve that desired,
mhm,
that whatever that benchmark was set,
mm.
then only you can consolidate that particular child series into main in next cycle, next conversion cycle, not immediately.
Okay.
Okay, now question would be like, anyways, why we are creating multiple series? I'll tell you a secret as well.
Mm.
To make a fool to the investor that look, when you invest, we are creating new series for you, and there are the expenses which is already incurred, just pay it. Fund manager want to charge more fees to that particular series. So he'll say, look, I have just created series. I'll pay more attention. That's what I need,
Mm.
more money from you. If I say, look, you don't need to worry about it. I have already, main series. I'll add you there. So you'll get the benefit of all lead series to you. You are in profit. You don't have to worry about your 100%, that expenses and all. Already that leader is bearing expenses. You just need to pay, let's say, 0.2%, 1% expenses. Then that investor would be in profit. Why should I do this?
Mm.
Right? Let's say you have invested 1 crore in mutual fund or hedge fund, whatever fund. What matters to you as an investor? Just think. Even if I create separate series or lead series or blah blah whatever this, what matters?
Return.
Return.
All that matters to you. Yeah.
Your first question would be, look, I don't even know that what structures that you're talking about. Just let me know if I invest 1 CR, how much I can expect the return from this investment plan and duration. Just tell me that. Correct. So that's the secret, but we cannot see that if you're looking for any interview and all, just like fund manager want to fool to us. But anyways, so yeah, in terms of accounting, we'll have to book the expenses, income, and everything under every series, and ensure that the
Okay.
series achieve benchmark. Once that series is achieve benchmark, then you can consolidate all that series in one, and you can reallocate it, and you can reallocate their NAV and everything to the
Mm.
the accounts. So this is what your allocation come into picture. Multi-series, it means create a series every time under main fund and reallocate it. So that's become your multi-series method. But again, why this? We were now your question will be like, see, we were discussing about standalone and why suddenly came in multi-series, because I was saying here. So under standalone only you can see the series, multiple series. Your fund is standalone, your fund is single, but still you can create a multiple series. You can create a multiple classes even. I'll send you an example, right, in your WhatsApp group after this class.
Okay.
Just go through it, how multiple classes looks like. That would be in Excel only. So I'll share that Excel. Don't share that Excel with anyone. It's a real
Sure.
example that I have downloaded. So you can just go through it, how fund creates multiple classes, how we calculate expenses and income for each class, even P&L balance its style. So we prepare that in a series and we compute NAV for per series as well. So this is what your standalone or series method come into picture. So that we create a multiple series. But let me just tell you, in private equity, we don't create that multiple classes. We just create one fund and we try to manage that under series only, series 1 or series 2, through series only, series or scheme 1, scheme 2, scheme 3, scheme 4, kind of that. So to create a multiple classes, it would be again difficult. And anyways, your most of the private equity funds by nature, this would be like close end funds. Multi-series method
Okay.
or series method, that will apply to the open end and unitized funds. So unitized, it means hedge funds, mutual funds, or fund of funds, or any funds which has created a units in the market, right? So your series method, it will apply to them. And apart from that, if you have anything like, let's say, close end funds as such, in that case, that doesn't make sense to create a multiple classes. You can create a series, of course. You can announce series, close end series, and once the fund targeted, let's say, amount or fund is raised, then you can close it out.
Mm.
So
Okay.
that becomes your close end funds. And in that, in the close end funds, you don't need to create a multiple classes. You can create one, raise the fund, and close it out. So once you close that series, then you cannot reopen it. It will directly redeem. Let's say you have invested this series in, assume it we don't have a classes. Where is that? I'll modify this one. Let's say we don't have a classes. We have only series. What I'll do, All right, we have only series, and in this series also, this is what you have: investment, we you have total NAV, which is this one, but actually you have invested this investment in Wipro stocks. You have investment in stocks around this amount, and here you have investment in Infosys. All right. So once you create this series, so your here would be duration, let's say 2 years. Then your investments, it will be locked for 2 years. You cannot redeem it. Here, let's say 3 years, and then your investment, this series, it will lock for 3 years. Then you cannot redeem before that. And that's what, retail investors, they are not allowed to invest in hedge fund and private equity, basically. Once you invest, your fund will locked. Once the fund is locked, so it means you cannot send any redemption request as such. They set up redemption period as well. Let's say after 1 year, they'll initiate redemption. Maybe after 5 years, they'll initiate redemption. And then only you will receive redemption. Before that, you cannot opt for a redemption. Are you getting my point?
Yes, she.
All right. Then let's say you have received investment from this. So basically, once you sell out the stock, so you will receive, it was stocks. So once you sell the stocks, let's say sold at, so you have received gain. So once here you will receive it. So your NAV was, previous NAV was 10. So now your total NAV would be something around 5% as a gain. Cost and gain. TNA, total NAV. So this you can distribute to the investors. So once you receive it, distribute, let's say total amount. So once you received this one, total NAV, so your balance should be 0, remaining balance. And then finally announce closure. So this series would be closed. You can close this series, then you can reopen new one. If you want, you can then announce series C. If investor want to roll over, let's say same investors, this amount they are interested to reinvest it, then you can shift same investment. That distribution would be your, again, subscription. But that would be under different series, not under same series. This is what your series works. So compute means open, calculate. Then once that series matures, then redeem it, and again create a new series and shift entire fund there if the investor want to continue. If not, then process the redemption, ask investors to accept it, and your job is done. with that particular series. So this is what we actually, perform accounting with the different series. All right. So let me know if you have any questions now around this. This was all about your
Was
standalone series.
so she like in close ended funds.
Hmm.
Do they like create a series and then merge? Are they allowed to do that?
No, they directly redeem it. So
And
that doesn't make any sense to
okay,
merge. That's what I was saying. In a
okay.
mutual fund, unitized fund, you can merge it because unitized fund mostly,
Mhm.
those would be like open-ended funds. Your series is actually open, correct? So it is on.
Mhm,
So
okay.
in that case, you can continuously merge it. But in private equity, your 90% funds should be like closed-end funds. So that doesn't make any sense at all. The best option is to directly redeem it.
Yeah.
All right. In private equity, we directly redeem it. Okay. Now your question would be like, why we are redeeming and creating new one? So once you redeem it, investment managers will receive their components. See, fund manager never see the benefit of investors. They always see the benefit of them only. If they redeem it and close it, so they'll receive their realized income from that particular series, and that's what they try to redeem and create a new one. That's the background story that nobody share. Let's say, let's assume it. I have generated, or I have provisional fees. I'm a fund manager and I have received 1,500 or 1,000 USD payment, which is unrealized. Unrealized basically it means which is under clawback, provision. I know it. My income is 1,000, but still I cannot use it. Why?
No, sorry, Shiv, I didn't understand what's the clawback. Maybe I
Clawback, it
missed.
means it's a provision if I get the profit from this particular series. So until this series get mature or redeem, I won't be able to use that money. Fund manager
Okay.
receive commission, correct? Or profit.
Right, yeah.
So if you see in this particular deal, we have 5,000 profit, correct? If I calculate 20% of 5,000, it goes around 1,000, right? Let's say my profit percentage is 20% as a fund manager. But if, let's assume it, this particular series is still open. If the still is open, it
Mm.
means it is still at to redeem. Then I cannot. I'll receive
Mm.
that unrealized gain, but I won't be able to utilize it just because of clawback provision. Clawback is nothing but
Okay.
that provision is for until investors get the capital and their provisional let's say interest payment back. We cannot use that profit percentage for our personal use, even if I have earned it, but still I cannot use it. And that's what they quickly try to redeem that particular series. Once they announce redemption, by default, they'll receive their percentage.
Okay.
Let's say you're a fund manager and I'm an investor. This particular series one is in profit, means, see, total profit, that is not the job of your fund manager. Fund manager only look his profit. Let's say you have profit of 20%, which is 1,000 in this particular series A. But that profit, which is basically you have not received it, then what makes sense? What will you do? What would be the next course of action? You are a fund manager. Come on.
Sorry, can you repeat that, Shiv, again?
You are a fund manager. You are a fund manager and you have 20% unrealized gain in this particular series. Unrealized gain.
Yeah. Yeah.
If you want to realize it, what will you do?
That's a closed fund, right? So I cannot do that.
Then only you will realize your percentage, correct?
Yeah.
That's what I was talking about. In a fund series, if you see the if fund manager has any unrealized gain, all right, then fund manager, if that fund manager
Mhm.
is not able to, let's say, access or uh, withdraw that fund, then fund manager will see how he can quickly, figure it out and announce the redemption of that particular scheme.
So is it like possible, let's say they have realized a good, uh, so but the contract, let's say, has another 2 months or 3 months to for that fund to get closed.
Hmm.
So is can
They
fund
can,
managers like close that fund and realize the gain because
yeah,
they
they
might
can, they
think
can,
that
they can.
if they
They can announce early redemption as well. See, if
Hmm.
assume it, you have received now, you have sold out investment, correct? Do you see any open trade in fund? You have sold out your stocks.
Hmm.
Now you don't have any open
Yeah.
position. Am I right? If there is no open position, then why will you wait for a redemption, then redemption of this series then? If you wait, then you will have to pay extra interest payment
Hmm.
to the investors
Hmm.
on capital basically. And nobody want to do this. Are you getting my point?
Yeah.
So to
Got it.
avoid further, expenditure, interest expenditure on capital, you can immediately, once you receive cash, then you can immediately announce redemption, transfer money to the investor's account and announce the closure. Hey, now I have closed the series and I have even transfer your money or share in your account. Done. Then also you can submit the same reports to the regulatory bodies as well. So we had, let's say, two series, series A and series B under this fund. So now we have announced the redemption of series A. So now we don't have any series further. So we have only one. So we'll see once we announce new one, we'll notify. This is what they play very diplomatically to redeem the series on time to time.
Yeah.
We believe like we are in a mutual fund, you can't do this. Of course, the reason is uh, regulator intervene everything, right? Before that, you cannot do anything. Once upon let's say upon the regulatory approval, only that you can go ahead with redemption and all. But in this particular business, we don't have any standard obligations which you need to follow. You can design obligations around redemption and all, then you can follow the same. But I have seen, I have gone through the more than 2000 plus documents. So in every documents which I have in common point, like every fund means fund manager, they designed rules and regulations which support to them only, and that would be under TNC, terms and conditions. Means let's say they'll say like we'll redeem the series after every 2 years, but in case if you see any unforeseen circumstances, we'll redeem that before as well. What it means, you have a regular, you have decided standard code for redemption which is, let's say, 3 years or 2 years. But again, when you sold out the investment, you have a cash. Instead, reinvesting, you are looking for redemption. Why? Because that manager want to realize his gain.
Got it. Yeah.
All right. So under series, you would see multiple, see the sequence. Under fund, you would see series, and under series, there will be your classes. Where is that? Yeah, there will be classes. Sometime you would see subclasses as well, right? And so it's a rare case that I would say where fund can create multiple subclasses also. Under class, you would see subclass, subclass 1, subclass 2, subclass 3. It's a rare case. If you don't want to establish your other class, then you can create a subclass. All right. But here again, the important is if you create any class, so we'll calculate NAV, we'll allocate expenses, we'll allocate each and every capital, subscription and all activities to each class. Your class total would be your series total, basically. Here, if you say your class total would be your series total, and series total would be your fund total, which is 400. So when we calculate NAV, so we ensure your fund NAV would be 400, your series NAV would be 200, and your class NAV would be 100. This is what the allocation works. This is what your standalone fund structure also works. Now just let me know if you have any question around this series. Otherwise, we'll jump on master and feeder.
Not from my side, I'm good.
Suraj,
No, sir.
okay. Just a minute. So now we have master and feeder. This is something unique one. Okay, why fund creates master and feeder? There are two, reasons. One is note down this one because in an interview, in a process, I have seen lots of argument around this. One is like why fund managers create this series. When you say why create, it means I'll tell you two reasons. One, if you have a complex tax structure, then you can create, master and feeder structure. So basically, you can, let's say this one is onshore. So it means if you have any onshore investors, means international investors, then you can create an onshore structure. And for a domestic one, you can create a offshore structure. Let's say you have established your entity in India, but you have received investment from US as well. So all US investors you can update under onshore, and all Indian investors you can update under offshore. And in feeder also you might see classes as well, like class 1, class 2, or maybe even multiple other things as well. But in 60 to 70% cases in private equity, I haven't seen classes under feeder. They directly, create feeder 1, feeder 2, that's it, under master, and they maintain it. Because in a private equity, the number of investors should be very less, 10 to 15. So that's become easy to even manage everything, not like 100 or 200 or 400 and thousands. In a mutual fund, you would see thousands or lakhs, of investors. That becomes difficult to manage it. Under hedge fund, you would see investors in thousands again. But in private equity, you would see, the investor names, like you can easily count on fingers as well. Max to max 100, 200, max to max. Are you getting my point? So we don't create a multiple series in mutual funds, in private equity, but in mutual and hedge funds, you can create a multiple series under feeder as well. So it means you might see structures like under feeder, you can create a series 1, series 2, and under series, you can create again classes, and again classes, you can create a subclasses. So you would see that type of complex structure even in your mutual fund. But in private equity, it's not possible even, because it's not a unitized fund. So allocation and all, it's become difficult. So that's what max to max, what you can see, master, then your feeder, and class 1, class 2, depends on your investments. Let's say class 1, that you have decided to maintain your loan transactions. Maybe class B, you have decided to go ahead with, let's say like this, investments, loans. Here you have decided to invest in bonds. You can see that structure. So it's possible. The same here, maybe you have any different plan like ABS. And here also ABS, asset-backed securities. So you can create a series, multiple series, and you can manage that investments. All right. So total of investment, it will tie with your class, and classes total will tie with your offshore feeder, and feeder. Then you can, it will tie with your master as well. See, master will maintain accounting at master level. See, note down this. Master will record or record every transactions at master level. Feeder will record all transactions at feeder level, and class will record all accounting entries at class level. Now I'll come to the why. We were discussing about why. The one aspect is, as I said, if you have uh, domestic and international investors, then you can create a class, separate class for domestic, separate class for international. Why? Because of tax. Maybe here you would see taxes which is 10%, and here you maybe see which is 15%. So that's become difficult if you merge all investors in one bucket. That's what we create structure like master and feeder. All right, one which is tax, another one is if you have a diversified investors or investors from different geography, I would say. Okay, second thing, trading. See, master only focus on trading part. Master focus on trading part. Master invest time on research. Master invest time on different variety of financial instruments or institutions. Then even they manage their master agreements with different counterparts and all. Master basically dedicatedly they focus on investing part. All right, their main job is investing part. But feeder they raise investments or accept subscriptions and all from the investors, and transfer that amounts to the master for investing purpose. So you would see the sequence where investor invest in feeder, and feeder invest in master, and master invest in equities. So in short, if I create, let's say, how a structure looks like. Master, under master you would see feeder, feeder B, and under feeder you would see investors. Investor A, investor B, investor C. Same now you can see under feeder B as well. So you have now master basically focus on investing part. Active trading entity. Note down all of this. You may expect lots of questions on this. Active trading entity. Then accept capital for investing from feeder and any individual HNI or institution. All right. Master allocate P&L, profit and loss to the feeders. Master charge fees to the feeders. Master allocate, not allocate, sorry. Master active trading entity accept capital for investing from feeder or any individuals feeder. All right, what else? What else? What else? Master, it's active trading entity. Okay. Fund flow. Fund flow. This is very important one. Note down this one. Feeder to master. That would be your subscription. If you see any fund from transfer from feeder account to master account, that would be your subscription. Come on, or capital call. Then same fund from master to feeder. This would be your redemption. Redemptions or distributions. Feeder to feeder. Feeder to feeder. This would be your internal transfers. Internal transfers. So again, if you see any question around this, master, it is like your trading, active trading entity. They focus on investing part basically, and also they allocate profit and loss to the feeders. All right. And if I talk about now your questions, right? What would be questions around this? Questions should be like, is it allow individual or HNI to directly invest in master instead of feeders? Is it allow? Yes, is it allow? It is allow. They can invest it. Then second, how when feeder invest in master, how that accounting works. Okay, this one is important one. The master treat as a capital, and we record accounting entry like cash account debit to capital account credit. There is no change in accounting entry when you received investments, which is subscription from feeder. Same for redemption as well. Redemptions to feeder. Accounting entry would be capital account debit, cash account credit. All right. Let's assume it you have received this one. Then under feeder, have we recorded under feeder? Let's say feeder fund has received first you need to prepare entry where investor processing, so it means investor invested. Subscription received from investor. This one is different activity. The accounting entry would be cash account debit, capital account credit, and second, feeder subscribed in master. And in this case, accounting entry would be investment in master account or affiliate account debit, to cash account Suraj, are you there?
Hello, yes, sir.
Okay, okay. Account credit. You have feeder now. Condition is first you have received subscription from investor, and then second is feeder subscribed in master. So feeder will treat as an investment. A very important one. Same entry you would see here as well, so that you can prepare. All right, and then in investor book, investor will also record. In an investor book, your accounting entry would be the investor will record it. Investment in feeder account debit, cash account credit. All investors will record same entry. So the amount basically will record weekly. Let's say this A investor process 300, 300, 200, 200, 500, 500. In the books of investor, they'll record it as an investment in feeder. All right. So total, if you just calculate cash, 1,000. So let's say feeder received 1,000 as a capital, and then again that feeder invest 500 out of 1,000 in master. All right. Subscription received from feeder A and feeder B. So you might see a categorization as well. So capital, it means, so feeder master can record like under capital account, feeder A, feeder B. Total contribution maybe equally, or sometime you would see change in this percentage as well. It's like, let's say, 500 from this, 300 from this, and master contribution as well. It is 200. You might see that also. It's not something where if Shivraj told, it means it would exactly follow the same. No, you might see customization or the additional feature, exotic feature in this process also. Right, so you have now master feeder. See here, same amount you might see here, and the investors, they have invested in feeder. What, only two feeder invest only 200, no, 300, 300, 300, 300. See, apart from that, see, you can you can record expenses, you can compute NAV, you can do everything. So it means under feeder will have to do or will have to perform all the tasks. your NAV calculation, your expense allocation, booking of expenses in the books of feeder, booking of expenses in the books of master, allocation of management fees. So sometime you would say split of management fees. Let's say 2% is the management fees, right? 2% management fees, correct? But that 2% you would say split between master and feeder. Maybe let's say 1.5% your 0.5% master will charge, 1.5% feeder will charge to the investor. So this is what your allocation come into picture. This is what your split come into picture. Sometimes feeder can transfer management fees to the, because feeder will collect management fees from the investors and send it to the feeder. So it means master will charge management fees to the feeder, and then feeder will charge management fees to the investors. If not, then let's say master will charge fees to the, right, master will charge fees to the feeder, feeder will investors, or sometime master can directly charge fees to the, or allocate and charge fees to the feeder. So flow, it means sometime you would see, bottom to up or maybe up to bottom. So that depends. All right. So flow is depends. Up, up, maybe down. So it's a kind of bottom and top approach, you can say. If it comes from investors to feeder, feeder to master, that becomes your I would say, bottom approach. And if you see master to feeder, it means that becomes your top approach, top line or bottom line. That depends on the fund structure. So you can read funds, documents or prospectus, which helps you to understand the structures and everything, and even allocation rules as well. All right. So few important highlights that I just want to again summarize, because Sunny was not there, I believe. One is anyone can invest in master. It's not mandate that only feeder can invest. Even you can also invest it, because master, it's a trading entity, so they can raise funds from any other individual investor also. That's what I have even written over here. Then master allocate profit and loss to the feeder maybe every day, maybe every week, as and when their cycle goes on, so they allocate it. Then another one is in terms of fund flow. If you see any fund flow from feeder to master account, then you can say it's a subscription or capital call. If you see any fund flow down from the master to feeder account, that becomes your redemption or distribution. And if you see any transactions from master to master, that becomes internal transfers. Now, sometime maybe that you may expect like question, what if sir feeder A transfer funds to feeder B due to XYZ reason? Let's say, let's assume it now. If you see, if you just compute the cash and assets, so we have cash balance which is here 500, asset is 500, and cash is 500. Correct. But let's say this particular fund has incurred expenses of 700. Would you be able to book the expenses of 700? Come on.
No, Shiv, because cash is just 500.
Then what would be next step?
So we redeem the assets.
Come on, come on. Just think what, how we can record this. Hmm?
Mm, Prepaid expenses.
Mhm. Incurred, it means, let's assume it now you will have to make the payment.
So can we adjust from some other feeder?
Exactly. Maybe you can adjust it from feeder or even master as well. But they'll not say sometime they'll charge even interest payment as well. So here, if you want to record this, then check if you have any balance available with another feeder under same fund, under this fund only, master only. Let's say this is ABC master. So under ABC master only, you can check it. And let's say we got to know, okay, so we have around 500 over here as well. So that we can transfer funds from feeder A to feeder B. So how you can transfer it? So there is a process. Your accounting entry would be over. You can prepare accounting entry like receivable. Note down this one, please, in terms of internal transfers. Receivable from feeder A account debit, cash account credit. Fund, let's say you are short on 200 because you have 500 cash in your books already, means feeder A. Just you are looking for 200. So 200, 200. And in the books of feeder A, you will have to prepare accounting entry like uh, cash account debit to payable to feeder B, sorry, account credit, which is 200. So one will basically treat liability and another one will treat assets or receivables. So it will receive. So once we have enough cash under feeder, then you can reverse that out. All right. If you get, let's say, maybe next week that you have received extra cash on feeder A, so you can transfer that cash to feeder B back. That's what we create payable and receivable like in this direction, and then we utilize. Then only you can record this transactions. Otherwise, you cannot record this. Add on cash received from feeder B, which is 200. That's how you can record your transactions. Now it will tie expenses. See, and in the books of this one, this you know feeder will record 700, sorry, 300 as an investment in feeder, then 700 as a cash. Incurred expenses, assume it no expenses received, and receivable would be of 7 or 2. So cash which was updated cash would be 500 and then 200 as a receivable. See, then it will tie their assets, total assets, which is tied with the 1000. Then what about liability? So here you can create liability as well. Liability of 200. So total cash we have 1000, but out of this now we will not have any cash once you make a payment. If you see, it looks like this, and total liability also that you have it. So NAV of feeder A, it could be different now, and NAV of this one, it could be different. If I calculate NAV here, total net assets value Total need assets. See, 1000. Three hundred only. This is how your master and feeder structure works. So your this includes in your day-to-day job even, because you will have to check, if you are paying any, or if you have received any work payment of expenses or income or any other things, so that you can, adjust it from the other feeders or masters as well. Meanwhile, and once you receive payment under that feeder, then you can reward to them as well. So day to day, we work on those things and we manage it. I'll just quickly walk you through. I have on documents. Let me just check for master and feeder. Let me just quickly check. Where is that? Here.